Welcome back to America's Commercial Real Estate Show. I'm Michael Bull. This segment's brought to you by RedIQ.com. This is a new sponsor, and they do some great service. They extract data from static property operating reports to transform it into actionable intelligence. So check them out at RedIQ.com. Well, today we talk about single tenant net lease investment world. And, I know some people are concerned about the government shutdown. Some people are concerned about, what we've had some turmoil in the stock market. And people are turning to real estate these days as maybe a safe investment. And for people who don't want to mess around with management of multi-tenant big properties, single tenant net lease properties are a great property type to buy. Our guests in Studio One here are Nancy Miller today with Bull Realty and Andrew Ziffer with Greenleaf Net Holdings. And I'd like to ask you guys about some of these returns, as you mentioned in the previous segment. You might get a 4% or 5% cap rate, which is your cash on cash return if you're in your first year if you're buying these properties. But how do you guys help when you're looking at, maybe I want a little bit higher return? What are some tricks to get a better return on these types of properties?
Tricks. Well, number one, you're looking at a lot of properties. So I'm looking at probably hitting the delete key on 100 properties a day, and it's actually a little bit of a nuisance. But most of the properties we see are the 4 or 5, and maybe some low 6 cap deals. So number one, it's look. And so when we find the deal that's 6.5 or 7 cap, we're getting into the 7s, we take a little bit harder look at it, because if they're pricing it at a high 6, they're trying to be aggressive in their sale. So we're looking at what the broker's advertising first. And then after that, we have the conversation with the broker, let's get the story, and then we're always trying to target something in the 7s, because the 7s will give us the distance between the cap rate and the interest rate, because we do get debt on these deals. We'll get a 65% loan on these deals usually. That's the ideal sort of loan we've figured out. We try to get a cap rate in the 7s, and that lets us pay our investors.
Are there certain tenants or categories that you look for that maybe have a better return but you still feel safe with?
There are categories that do pay higher cap rates, like a lot of auto parts stores I've seen at higher cap rates, but we're not doing auto parts stores, we're doing mostly restaurants. And so what we've seen is that the restaurants with shorter leases will typically be higher cap rates, or honestly, our biggest find are usually that a restaurant that we title as priced incorrectly. And so if it's priced, the broker didn't price it correctly, they didn't do the research, they might have priced it a little bit too low, and it's not initially we share that information, but that's the ideal situation. So typically we do want to make sure that there is some type of value in the property. And so the biggest value for the property is always that business will continue its operations indefinitely. Yeah, that's the biggest value.
And to that end, Nancy, for investors that are maybe trying to get a higher return on these single tenant net lease properties, are looking at properties with lower terms left and less years left a model, and what should they do there? They're considering those.
Several strategies that I recommend. One is to look at a quality tenant. It could be a franchise or it could be a corporate guarantee tenant that might have 4 or 5 years left on the lease. If the real estate location looks pretty good, if the tenant has a history in that location, if there are remaining options left on the lease, and if there are rent increases in those option periods, the risk is mitigated to some degree, and you're going to get it at a higher cap rate. Another strategy is to look at a double versus a triple net, because the landlord has a little bit of the burden on them, and usually you'll reflect that with a maybe 50 basis point, give or take, improvement in cap rate if you do that.
So for listeners who may not be in the single tenant net lease world, a double net versus a triple net, does that mean the landlord might be responsible for roof and parking lot? Or?
Roof and structure, depending. Okay. And today, in O'Reilly's, who's a fabulous double net tenant, your responsibility is structure and roof, and the roof usually comes with a 20-year lease. So if you get one, warranty. Yeah. So if you get that, in the early years or even later on, you've got plenty of warranty time left on that roof.
And do they maintain on that particular tenant, maintain their parking lot themselves?
It depends on the tenant. Sometimes they
lease.
do, sometimes they don't.
Okay.
And
So some other ideas for getting higher returns on these?
I would say that if you're not looking to buy something on Main and Main, if you will consider something in a secondary or tertiary environment, a dollar store, for example, people say, oh, who's going to go out there? Well, I can buy that dollar store with a new 15-year triple net lease in a small town out in Podunk for about a 7% cap. I can buy that same dollar store in a larger city for a 6 cap or 6.25 cap. So if I am cap rate sensitive, I may look at the geography if I'm willing to take what I call the risk, because in that small town, if they go dark, the population is smaller and the likelihood of repurposing is a higher risk factor for people.
Yeah. Well, let's talk about mistakes to avoid. And single tenant net lease properties are somewhat simple. There's one lease, and maybe the tenant's taking care of everything. But what are some of the things that can be gotchas?
Well, we had a big gotcha in December of this year where we actually had a property under contract, and we went through lawyers' expenses. We had a lot of due diligence money invested in it, and during due diligence, we had the store manager actually tell us, oh yeah, we were looking for a new site. And so that was great that we found out at that point in time, but little nuances of information during due diligence is very important. So, do your due diligence is the number one rule that we always have. And if you don't, that could be a costly mistake in the future, because in 5 years when that short-term lease expires, the tenant could be somebody relocating, and they could relocate across the street. So you have a dark location with very little reuse, because if it's a fast food restaurant, it's always been known as that fast food restaurant. So how do you make a McDonald's a Chick-fil-A? I mean, it's hard. It's hard, yeah.
Yeah, and yet listeners, I realize a dark property like that means they're still paying the rent, but they're not open, and it makes you real nervous as an investor or a lender when that happens, right?
Yeah, that's a triple net investor's worst fear. Dark property.
There's no one there taking care of it.
Yeah.
Nancy, what are some other gotchas?
Well, there are two things that come to mind. One is that if a tenant has the right of first refusal, if I'm going to be buying that property, I want to be assured as soon as I can that the tenant is not going to exercise that right of first refusal, because I'm going to have spent good money up front starting my third-party reporting and doing all the things that I'm supposed to do to buy that property. So usually there's a window of 7 or 10 days, so you might put in your LOI or your purchase agreement that the due diligence period starts upon the waiver of the right of first refusal from that tenant. And a second thing that I think is that using, and this is a self-serving comment, but using a broker will allow someone who is trying to find or sell a property, put them ahead of the game. If I'm trying to find something, the broker can find things off market for me that they might not otherwise find because of their contacts or working with developers, as we often do. And then also on the selling side, we just recently listed a Sherwin-Williams. We knew it was very aggressively priced. We've had multiple offers nearly at full price, and we are under contract in a very short period of time. Otherwise, that would be a very, very hard thing to have that seller realize that level of a net to them if they try to sell it themselves.
Yeah, the increased demand. Let's talk about the shutdown, the turmoil in the stock market. Are there any of these tenants or categories of tenants that maybe people are a little more concerned about today in the single tenant net lease world?
Well, the biggest story I know is Dine Equity, which is now Dine Brands, and Applebee's. Applebee's has been in the news for years, suffering, not doing so well. And in 2018, they had a remarkable turnaround. I think I read something this morning where they have 43 weeks of consecutive store sales increases. And the stock itself, the parent company, Dine Brands, owns IHOP and Applebee's. And their stock started January 2018 at 55 and ended the year about in the mid 70s. So that company is doing very well just basically on IHOP and Applebee's.
Yeah. What tenants are out there expanding today and that might be opportunities?
Well, I did a little homework before I knew you might ask me that question. The big player of growth is the dollar store. Dollar General opened over 200 stores this past year, and Family Dollar as well, about 70 stores. Other folks, Burger King, 57 stores, 7-Elevens, and Starbucks seem to be the top ones. But I might also add that these folks that are, to the question about the economy and what's happening with the shutdown, I think that if we look back at 08 and 09, what happened was that the consumer buys down. Mm-hmm. They go from casual to fast food. Mm-hmm. They start finding ways to economize in their purchases. Will they buy things from Amazon, toilet paper and so forth, or will they still go to the grocery store? What will they do to save money? So I think in the near term we're going to start to see that. So your budget retailers, if you will, or your QSRs and even your auto parts people, they'll probably in the next couple quarters do very well. That's my thought.
Let me get your thoughts on categories like drugstores.
Health is I won't touch anything health
medical
related.
or drugs.
Medical or drugs, and not necessarily because I don't trust the actual business itself, mm-hmm. because the not to get political, but the government mm-hmm. changes the dynamics of that mm-hmm. of that vertical with legislation, and so you might have a property or like drugstores. There's drugstores that are suffering, and there's drugstores that are doing well, and the drugstores that are suffering are the ones that don't have the big partnerships because of some government program that mm-hmm. does X, Y, Z. Mm-hmm. So in our model, we completely, myself and at Greenleaf, we just avoid anything that has to do with health, pharma, or even medical care. So anything, mm-hmm. that whole category.
I would say, I take maybe a contrarian view to that. From talking with my lender people, the people that they lend to, they love pharmacies, they love your kidney dialysis, your DaVita's.
Which are very good cap rates, by the way.
That's right. They love that as well. And I think as the baby boomers age and go on Medicare, they have to choose a drug plan. And one of the ways that they choose a drug plan is they have alliances with Anthem, with Rite Aid, CVS, and so forth. So it's actually, I think, going to cause, and I don't like necessarily the drugstore sector that much because they're long leases, often flat leases. You know, there's no upside. They're basically for a pension fund most of the time. So I think that the drugstore world could benefit, be a hot one, and franchisees, as we talked about, when in a slow or an up economy, a franchise or a QSR is going to also be popular so long as their credit stays strong and the grub hubs of the world don't take too much business out of the site. And
let me get you quick comments on banks as single tenant net lease tenants. Today, it seems like there's less banks, but there's some new ones popping up.
That's right. My visual on banks, but I...
So your banks are my health, is that what you're saying?
That's right.
Okay.
How about coffee shops?
Coffee shops, I've never seen a cap rate on a coffee shop above six caps, so I just...
You just don't like the return.
A coffee shop is some guy who just sold a big piece of real estate, he's going into retirement, he just wants his 20-year lease, and it takes him into retirement, and it's his pension check. Mm-hmm. And he doesn't need anything more than a 5% return or a 4% return on his money. Yeah. That's who's buying those deals.
All right, let's, if you will, leave the audience with this. What do you expect for the single tenant net lease market moving forward as far as cap rates and stability and interest from investors?
Well, we're fully expecting interest rates to rise this year. There was a little bump down, but I still think there's going to be a rise, and I think there's always going to be an adjustment between cap rate, interest rate, and buyers and sellers' expectations. And so this is going to be, I think this is an adjustment year where cap rates are going to have to go up because the days on the market is going to go up. And then if days on the market's going up, the prices are going to go down. So That's what I see. And then I might have to buy a 7.5 cap deal instead of a 7 cap deal because my rate might be a half a point higher too. So that's what I see.
I see more 1031 velocity of people who are aging and selling the apartments and so forth. Many clients are doing that, and they want to get into simpler investments, and they realize that the cap rates on those investments are lower, but they're willing to do it because it's a mailbox money, it's very passive. I see some of that. And hopefully interest rates, as they rise, cap rates will come up to meet them a little bit. And once we see a little bit more of a rise in cap rate, it'll take several months behind the interest rate, but we'll see more investors come in the market because they'd like to get a deal.
Yeah, well, I agree. And I think single tenant net lease property velocity and interest is going to remain strong because I think if we are getting toward a recession at some point, no one's saying it's close, but if you're concerned about how long this cycle's been, a lot of people flock to safe investments, right? And single tenant net lease properties, the default rate, especially on the national credit tenants, has just been incredibly low, really. So I think it's going to continue. Well, Nancy, Andrew, thank you for all your information today. Appreciate you being on the show.
Thank you.
Thanks for having me.
All right. And thanks for joining us around the country or around the world. If you're watching or listening, thank you. And thank you for sharing. And thank you for your comments. Please connect with us on your favorite social media site. You can find them all at commercialrealestateshow.com. Until next week, be sure that you always lead, learn, and laugh. And join us for America's Commercial Real Estate Show.